Grist from the Mill, SpaceX, a case study in FOMO. Unless you have been living under a rock for the last 3 weeks, you have been bombarded by the hype surrounding the SpaceX IPO. Its $75 billion IPO filing for 555.6 million shares, which was priced at $135, is the largest IPO in history, eclipsing Saudi Aramco's $29.4 billion raise in 2019. Fueled by promises of the potential for satellite data centers that would obviate the need for energy demand and cooling systems, and the colonization of Mars, the IPO was oversubscribed by a factor of 3.5 to 4.0 times. The first day of trading, the stock opened at $150 and spiked to close up 19% at $161.11. The next day, as more retail investors jumped on the bandwagon, the price reached a high of $229.40, an astonishing 52% rally from its opening price. Shares of SpaceX gained roughly 16% on Tuesday the 16th, topping Amazon and Microsoft by market cap and making it the fourth most valuable company in the US. Within days, and coincident with the price spike to some $229.40, SpaceX announced the acquisition of Cursor, an AI-enabled coding startup, for $60 billion in stock, an immediate dilution of 3.4% to the newly minted SpaceX shareholders. As the first stage of the SpaceX retail investor booster rocket separated, the price dropped back to the mid-150s, and a 32% drop from the high in just 4 trading days. The following week, taking advantage of all the hoopla, SpaceX tapped the bond market for $25 billion in debt. And let's not forget those fortunate employees who were granted stock in SpaceX pre-IPO. News reports have heralded the number of millionaires that have been created from their ranks with the ringing of the opening bell on the NYSE. Those beneficiaries are restricted from selling their stock immediately, something called a lockup. However, those lockups expire, freeing up their ability to sell shares in the market, and the impact will not be insignificant. Beginning with the FYQ1 earnings report, anticipated in late July or early August, 20 to 30% of the restricted shares will be free to trade. Additional tranches of 7% of the shares will be free to trade in August, September, October, the 9th and 24th, and December, aggregating some additional 35% of the available shares hitting the market, for a total of 55 to 65% of issuance coming on the public market over the next 6 months. That's a lot more supply of shares. So what's likely to happen to demand then? Economics 101, supply and demand, and what will the price reaction be? Priced at some 90 times revenue, investors are seemingly untroubled by the fact that SpaceX generated a net loss of $5 billion in FY 2025. Q1 2026 accelerated that trend with a $4.28 billion net loss in a single quarter. The core takeaway: Starlink is the business you are paying for, the only profitable segment with a proven recurring revenue model. The launch and AI divisions are long-term bets that depend on execution of Starship and competing against dominant AI players like ChatGPT and Gemini. Recall my recent post, IPOs, What's the Hurry, and the academic studies cited therein. Maybe missing out on SpaceX wasn't such a bad idea after all. And that's why it's personal to me.